What we did last class is we started talking about definitions. And we talked a bit about financial statements. So just want to run through what we did the last two classes. The whole point of this course is financial statements being the report card for business. So we talked about financial statements, a little bit more complex than just a letter grade at the end of the semester, because we've got so many users, different people with different interests. So we can't just simply give an A, B, or a C. So our financial statements for a business, a report card, if you will, is actually 5 separate reports. We deal with 1, 2, and 3 in this course. We do not do 4 and 5. The statement of cash flow, you'll do an accounting 1210. That's cash in minus cash out. And the notes to the financial statements, if you can't say them dollars, and it's relevant information to users, they need that information, or it's desirable for them to have it, then we would put it in the notes to the financial statements. What we did is we broke it down right here, okay? And 1, 2, and 3, balance sheet, income statement, and statement of owner's equity. And the balance sheet, income statement, and statement of owner's equity, we were able to boil down to formulas. And you can see in yellow, those are the formulas for each of these statements. You must memorize. These. So for the balance sheet, we've got assets equals liabilities plus owner's equity. The income statement, revenue minus expenses equals profit. And for the statement of owner's equity, we've got the opening equity at the start of the period. So that's from, last year or last month. Then we add any additional investments or additional money that the owner puts into the business. Then we add the profit from the income statement. And here's the profit right here. Okay, that profit. Okay. And then we add we subtract the personal withdrawals that were made by the owner. And this is like his salary. A person sets up a business, to pay their bills, right? To pay their mortgage, pay their rent, buy a car, right? That's like their salary. They set up a business because they feel if they work for themselves, they can make more money than they could if they worked for somebody else. Plus, they get to define their own hours, right? So this right here, these personal withdrawals made by the owner, this is the owner taking money out of the business to live on. And then finally, that equals the closing balance, and that is this closing balance right here from the balance sheet. Those two numbers need to be the same. So note the relationships. We also talked a little bit about the definitions of each of these elements in our formulas. We said an asset is what the business owns, right? Everything the business owns. And it has the F word, future benefit. Right? Then we have liabilities. These are what the business owes. And the residual, what's left over, owner's equity equals the assets minus the liabilities, the leftovers. That is what the owner owns. That's what the owner owns. Now, revenue is an activity performed to earn income. Now, it is the activity, okay? Remember we talked about the sweaty armpit test? Did you do it? Did you sweat for it, right? Is it done? If it's a hairdresser, was the hair cut? If it's a mechanic, was the car fixed? Was the computer repaired? Did you sell that can of soup or that pair of shoes to somebody? Has the activity or the sale taken place? Okay. If it hasn't taken place, then it's not revenue. Okay. So it has to have been performed. Then we have expenses, and these are costs to help earn the revenue. Now, what's different between expenses and our assets is this F word, future benefit. Is it all used up, or is it consumed? Right? If it's all used up or it's all consumed, then it's going to be an expense. If it's going to last a long time and we're going to have it next year or next month, right? Like a table or a computer, then it's going to be an asset. So these definitions are also critically important. We also talked about some assumptions that users of our financial information are entitled to make. Okay? They're entitled to make these assumptions by virtue of using our information. Right? These are called our generally accepted accounting principles. Our principles, constraints, and assumptions. There are framework. And I've also asked you guys to memorize these. When people look at our financial statements, they have a right to assume that they are looking at just one economic entity. Okay? So the economic entity or the reporting entity concept, it states that each entity is separate and distinct from other economic units. Okay? The owner is separate, business number one is separate, business number two is separate. They're all completely separate. Why? Because we've got to be able to evaluate each economic entity on its own merits, on its own performance. We can't jumble up personal things in the business because it's going to mess up. It's going to mess up us being able to properly evaluate the business. The going concern assumption. In this course, we are dealing only with going concerns. The going concern assumption is the assumption that at the time the financial information is prepared, it looks like the business is going to be able to operate into the foreseeable future. Okay? It's going to remain in operations long enough to use its assets for their intended purpose. Now, of course, there's no guarantees, but it looks like it can survive into the foreseeable future. Okay? If we look at the business and say, oh, no way, they're done, they can't make it, well, then different rules apply, and that's a different course. Curiosity. It assumes that an organization, their activities can be divided up into pieces for the purposes of evaluation, right? So we can take a segment of the business and evaluate it. Now, school is like that, right? For your university degree, it's divided into semesters. And at the end of each semester, you get an evaluation. Right? Same for business, right? At the end of every period of time, it gets an evaluation. Now, by law, we have to do this annually, by law. If our 12-month period ends on December 31st, we would say that this is a calendar year. If our 12-month period ends on any other month, we would call it a fiscal year. Now, optionally, we can do interim reporting, which would be additional monthly or quarterly reporting. Okay. Now, I call this optional because it's not legally required. However, if you are listed somewhere like on a stock exchange, to remain on that exchange, then you'll have to report quarterly. Okay. Number 4 here is a stable monetary unit. Essentially, we ignore inflation. And we also report in the monetary unit that's relevant to our users. In Canada, that's usually the Canadian dollar. Okay? If we operated in the United States, perhaps we'd have to use the American dollar. The 5th one was revenue recognition. Now, we know what revenue is. Right? Revenue is an activity performed to earn income. Now, depending on when we do it is important. If we perform that activity here now in September, then that activity is part of September's financial information. That would be part of September's revenue. So revenue is linked to the timeline. When we perform that activity is the period in which we will include it. Right? So we perform that activity in October, then it would be October's revenue. And it doesn't matter when we get the cash, right? Revenue is the activity. People can pay us today and we might not perform the activity till next month. That's not revenue. People can pay us after we perform the activity, right? If we perform the revenue or the activity today, it's revenue. If they don't pay us for 2 months, it is still revenue. It's still revenue. It goes by when you do it. Okay? Number 6 is the matching criteria that has to do with our expenses. Okay? Our expenses, cost consumed to help earn income. These expenses are matched, matching criteria. So they're matched or linked to the revenues they help earn. And of course, those revenues are linked to the timeline. Okay, so we recognize them generally when they're used or consumed. We've got the cost principle, which says that we record things at the price we actually paid for it, okay? Or whatever we had to give up in order to acquire it. So if we buy something on sale for $50, well then, it might be worth 75, but if we only pay 50, then we record it as 50. The reason we use the original historical cost is because it's reliable. It's reliable. Now, 8 through 12 are 8 through 13 are some characteristics of financial information that are desirable. Okay, it needs to be relevant, needs to be faithful representation, accurately depict what's occurred, comparable, verifiable, timely, and understandable. Please ensure that you understand all of these definitions. Please ensure that you know what they mean. You know what they mean. Okay, and you need to memorize them. You need to make them part of you.